Most business owners have a number in their head, a figure they have been carrying around for years that represents what they think their business is worth. And in a lot of cases, that number is either higher than what the market will actually pay, or it is built on assumptions a serious buyer is going to challenge very quickly. In this video, I want to walk you through how businesses are actually valued in Canada, what buyers are really looking at, why owner expectations often miss the mark, and what you can do to build a business that commands a stronger valuation when that time eventually comes to sell it. So let's get into it. Before we get into the mechanics, it helps to understand why owners and buyers often see value so differently. Most owners naturally think about the value based on what they've put into the business. Years of work, personal sacrifice, risk, long hours, the stress of building something when there is no guarantees. And all of that is real. But, hate to tell you, buyer doesn't pay for what you put in. A buyer pays for what they believe they are going to get out of it. So they're going to look closely at how durable that cash flow is. How dependent is this whole business on you? How concentrated is it? And how much risk sits underneath it? That is why business owners are often surprised by the valuations they get. They are looking backward at what they built, their baby. The buyer is looking forward at what they can rely on. Another thing that throws people off is that many owners anchor to revenue, not profitability. You hear it all the time. My business does $5 million in revenue, so it's going to be worth a certain multiple of that amount. But revenue is not what gets valued. Profitability gets valued. More specifically, what gets valued is the normalized, sustainable, owner-independent profitability of the actual business. And that number is often much lower than what owners expect. So let's talk about the foundation of most private business valuations. The foundation is EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is widely used as a rough proxy for operating cash flow, and in many private market transactions, it's a starting point for the valuation. But here's the part many business owners miss. Buyers usually do not just take the EBITDA number straight from the financial statements. They normalize it. Normalization means adjusting the financials to reflect the true economic earnings of the business under the normal ownership. That can include things like the following: adding back above market owner compensation, removing personal expenses run through the business, that's a big one, and stripping out one-time items that would not continue after a sale. From there, the buyer applies a multiple. That multiple reflects the quality, risk, and growth profile of that business. And when you multiply normalized EBITDA by that multiple, you get what is commonly called enterprise value. That is the starting point for what the business may actually be worth in the market. Now let's talk about multiples, because that is where valuation outcomes can change dramatically. In the Canadian private market, small to mid-sized businesses often trade somewhere in the range of roughly 3 to 8 times EBITDA. That's a wide range, and that matters a lot. A business generating $1 million in normalized EBITDA could be worth $3 million at one end of the scale or $8 million at the other end. Same EBITDA, very different outcomes. So what actually determines where a business falls in that range? In most cases, it comes down to 5 key factors. The first factor is size. Larger businesses usually command higher multiple because they are often more potential buyers for it and more confident in the durability of that operation. The second is revenue quality. A business with reoccurring revenue or long-term contracts or retainer-style relationships is generally worth more than a business with the same earnings coming from one-time transactional sales. Reoccurring revenue reduces risk, and buyers will pay up for the lower risk. The third factor is customer concentration. If too much of your revenue comes from 1 or 2 clients, that becomes a big red flag. Because if 1 or 2 of those large clients where the revenue is coming from leaves, the value of that business can change overnight. This is a big one. The fourth factor is owner dependency. This is one of the biggest value drivers owners tend to underestimate. If the business cannot run without you, a buyer is not really buying a scalable business. They're buying a business that still depends heavily on its owner. And that usually means a lower multiple. An example I always use for this is, can you go away for 2 or 3 weeks and your phone or email barely ring, vibrate, or anything? Can you go away that long with your team managing that? If the answer to that's no, then you want to kind of get those ducks in a row before you start thinking about selling. The fifth factor is management depth. A business with a strong team, documented processes, and people who can operate independently is much more attractive than one where the owner is still the center of every major decision and relationship, as we just discussed. And if you want a more structured way to think through this for your own business, we've put together a free guide on preparing your business for a future sale. Very valuable resource. It covers valuation, owner dependence, preparation, and the steps that can help strengthen your position way before an exit. You can find that below. Now, let's talk about why owners often get surprised when they finally test the number against the market. One reason is that normalized EBITDA turns out to be lower than expected. Once the buyer adjusts for compensation, personal expenses, and one-time items, the earnings power of the business may not be what the owner thought it was. And then there is deal structure. A lot of owners picture a clean sale with cash at close. But many private businesses' sales include some combination of upfront cash, vendor take-back note, and an earnout tied to future performance. And an earnout can look fine when the deal's signed, but becomes less attractive if the business underperforms later or if the buyer decides to change the way the business is being run, which can affect this. And finally, the market itself moves. Multiples do not stay fixed. Interest rates change. Strategic buyer activity changes. Private equity appetite changes. So if an owner formed their valuation expectation years ago, there's a good chance the market has moved since then. Now let's get to the most actionable part, because the factors that drive a premium valuation are not things you fix in just a month before the sale. You need much more time before that. In most cases, there are 5 practical areas owners can improve well before an exit. The first is reducing owner dependency. The second is building reoccurring revenue where the business model allows for it. Is there opportunity for subscription revenue, retainer relationships, long-term contracts? The third is diversifying the customer base. The fourth is getting your financial reporting clean and organized well before a transaction. This is extremely important. This is coming from someone who has bought multiple businesses. Strong financials do not just make diligence easier, they help support confidence in the number, and the potential buyers are going to feel much more comfortable paying a certain amount when the financials are extremely clear. And the fifth is getting a professional valuation before you're ready to sell, not an informal guess. A real assessment of where the business sits today, what gaps exist, and what it would take to close them. So an example of this is before you're about to go sell your house, I always tell people one of the best things you can do is pay for a home inspection for your house before you sell it. Don't let the buyer come in with a home inspection and show you all the cracks and things that need to be repaired. Same thing for a business. Get that done ahead of time so that there's no surprises and you can fill some of these holes to get a stronger valuation on this business. These steps roughly should be done anywhere from 3 to 5 years before an exit, and that gives you time to actually improve these outcomes. Not only does it improve the outcome for potentially selling the business, it's going to actually increase the value now, which will also potentially benefit you right now versus a buyer even down the road. So here's the bottom line. Business valuation it's not a mystery, but it's also not intuitive for most owners. A buyer is not valuing your effort. They are valuing normalized earnings, the quality of those earnings, the risk around them, and how confident they are that the business can keep producing cash flow after you're gone. The business owners who command the best valuations are usually not the ones who simply pick the right year to sell. They are the ones who understand what drives value, build toward it deliberately, and brought a clean, well-run, less owner-dependent business to market with realistic expectations. If you'd like a more structured way to think through what your business may be worth today and what could help improve that number over time, please download our free guide below. It walks through valuation, preparation, and the key steps that can help you build toward a stronger exit. Very valuable guide if you're even thinking of selling in the next few years. And if you want help applying all this to your own situation, you can also use our Calendly link in the description to book a conversation with our team to go over this. If this video gave you something useful to think about, please give it a like, share it with a business owner starting to think about their exit, and subscribe for more content on building and protecting wealth in Canada. I'm Kris Dureau of Green Private Wealth. Thanks for watching, and we'll see you in the next one.